What's up guys, Zane here from the Trading House, and today I got a video for y'all on how to trade debit spreads. And the reason that I wanted to make this video is because I know a lot of the times people have trouble finding cheap option plays to make, and a lot of the times on most stocks, at the money options are very expensive. So this is basically a strategy to help you find at the money options for a cheaper cost basis, and it has a lot of pros because it can save you from IV crush and theta decay, but it does have some cons such as a cap profit potential. So today I'm going to be going over that. Here I got the Tesla stock chart pulled up on Robinhood, and Tesla is a good example for this video because it is a stock that is notorious for having really high option premiums, especially at the money. The contracts cost a lot. So here, this is Tesla after markets closed, and it's currently trading at 955.90. So we're going to go over to trade Tesla options and pull up the option chain. So here we're going to be trading the options expiring July 2nd. So with this strategy, it really helps because you can buy at the money options, make higher probability plays, and your cost will be significantly lower than just buying that naked option on the chain. So here we can see the at the money 960 strike call option expiring July 2nd is trading at 2760. That is really expensive for an option that's expiring in 1 week, even if it is at the money. And I know a lot of people, myself included, in most situations don't feel comfortable buying an option this expensive, knowing it will expire very soon. So there is a way we could still play this play and get it for cheaper actually, and let me show you that right now. So we want to buy the option that we want, right, the 960 call, and we are going to sell or short the option right above it. This is different from credit spreads because with the call credit spread you would short it below it to collect a net credit, but in this case we want to bet that Tesla is going to go up, more specifically past 960. So we'd buy the option above it, short the option above it and collect a premium. Now, Robinhood recognizes that we want to trade a call debit spread. Make sure it says debit for this strategy. And what this does, as you can see here, is that it lowers my cost basis to $220. I just bought a $2.7 thousand option for $220. How did I do that? With the debit spread. As you can see in the order summary, I bought the 960 call for $2,700, but at the same time I shorted the 965 and collected back $2,500 in premium. So my difference, $220, that's how much I'm going to have to pay to open this position. So we can hit continue here and fill out the details. I'm going to go with one contract to keep it simple and review the order. And it just brings up the summary, and as you can see here, your true max cost is $220. Now, the pros with trading call debit spreads, or put debit spreads in that same respect, is that you can only lose what you put in. Unlike credit spreads where you have to put up a collateral, most of the times upwards of $250 per spread, which you can lose all of it if the spread goes against you. In this case, you can only lose what you put in, which is the $220. And this strategy, called debit spreads, also protect you from implied volatility crush, because if the implied volatility drops and these options lose value, well, you're also short one of the options. So when implied volatility goes down, it kind of counteracts the effect of this option losing money because you gain money on this leg of the trade. So another pro is that you will not suffer theta decay, and this is kind of options without theta decay, and you can only make or lose money if the underlying stock changes directions. So if it goes in the direction that you bet that it was going to go in, you'll make money, and if it goes the other direction, you'll lose money obviously, but you won't be a victim of theta decay, which is really nice. So those are the pros of this strategy, but there are some cons, and I'm going to pull up the option profit calculator here. This is a really good website in general. If you ever want to check what your max profit, max loss on a certain trade is, you come over here, pick your strategy, whatever you're trading, and then you put in the details. I already have that done for what I just explained on Tesla. And it will give you a full graph on if the stock ends up at what price by expiration, what will be your max loss or gain, or if you end up anywhere in between. You can run through all the scenarios and know exactly how much you can make and can lose. So here it shows us, as you can see, this is almost 50-50, meaning if Tesla goes up, we're almost guaranteed to make money, and if Tesla goes down, we're almost guaranteed to lose money. Now, you might think, oh, that's not that great, but in reality, when you buy a naked option, your chance of actually profiting are usually less than 50%. So to get this much of a straight up deal is pretty good. And as you can see, even if Tesla trades flat, as long as it moves up just at $5 before expiration, you'll still make some money. And the thing is, the only way you can lose money is if Tesla stays completely flat or comes down. So what this tells you is that theta decay won't screw you over in the end, which is really nice. So as we can see, our max profit is $280. And this is the other con of debit spreads, is that your max profit potential is capped. And it is capped because of the option that you shorted right here. So you bet that it was going to go up, but then you simultaneously made a smaller bet that it was going to come down. So because of that dynamic, your profit is capped at a certain point. And in this case, for this certain trade, this specific trade, your profit will be capped at $280. Alright guys, that was my quick rundown on debit spreads. And I hope you guys enjoyed the video and learned something. Thanks.